Welcome to the Investing Show, where we discuss ideas to help you make more of your money and the news that matters to investors. I'm Simon Lambert of This Is Money. Joining me here in the studio, I've got Richard Hunter of Wilson King Investment Management.
Hi, Simon.
Hello, Richard. And Nick Batsford of Tip TV.
Simon.
Nick. Well, we're going to be looking in the second half of the show with Chris Justham of Seven Investment Management at what's done well recently and also what looks like it will do well over the next part of the year and the years to come. But first, a few things that have been in the news. Most recent inflation figures, we've stuck at 2.3%. We've got a new tax year, so you have a new ISA allowance of £20,000. That has risen substantially, making up for the fact that people's pensions are now being crimped in an increasing crackdown on those. But looking further away from the UK, over the Atlantic towards the US, Mr. Richard Hunter, things have been fairly optimistic after Mr. Trump was elected in the US in terms of the investment markets. Everything's gone up, but then it seems to have stopped, and now it seems to have reverted to being cautiously optimistic. Would that be fair enough?
Yeah, it's a possibility. There has been something of a flat line in the States for the last few weeks after that initial euphoria, as it turns out, with the perceived business-friendly sort of attitude that the new president would bring. I think what's basically happened, we've talked before about the market being a discounting mechanism. In other words, it's trying to be 6, 9, 12 months ahead in terms of where the economy is likely to be. And with that in mind, of course, we saw that massive hike in share prices in the States. To the extent, what's basically happened is the markets have said, OK, Mr. President, we will meet you halfway. This is what we think is going to happen. Now it's over to you, and that's probably why we're pretty much treading water in the US and therefore to some extent in the UK. Now, more recently, some of the signs haven't been quite as promising as they might. He chose to tackle Obamacare first, the Affordable Care Act, pretty much without success. He wanted to repeal it and reinstate it, but he didn't get too far with that. Now, it's generally accepted, of course, that when you first become president, that's when you've got most political capital, and already he's finding out the hard way that it's not going to be easy to get things through. That, of course, immediately starts to cast some doubt over the likelihood of any sort of big tax reforms for similar reasons, because that's going to come at a cost to a national debt which is already quite huge, let alone infrastructure spending. So there's a couple of question marks just appearing, and also, of course, the fact that the market are waiting for Trump to start to deliver on some of those pre- and post-election promises. There's also an interesting aside, for example, on the infrastructure spending. Although the jobs numbers in terms of non-farm payrolls weren't great last week, the actual employment rate has now got the Federal Reserve Chair, Janet Yellen, basically saying we're pretty much at full employment. OK, so the US is at full employment. If you go on with several infrastructure projects in the US, who's going to work on them?
So, going back just to those promises, actually, it's worth probably recapping on them, isn't there? So, and the ones that the markets want, these, so talking about, investors, why the investing confidence? Why did people think there was going to be this Trump trade, this reflation? You've got infrastructure spending. He promised to spend a load of money on infrastructure, although whether that was new money or whether it was money that generated through projects and public-private partnerships, It was going to be more money going into infrastructure. You've got tax cuts, which were mainly going to benefit the middle classes, weren't they? It's fair to say. But also a corporate tax cut designed to try and get these giant American companies, especially the tech companies, the Apples, the Googles of this world, to bring back some of that massive pile of money that they've got sat overseas. Now, why did investors want all of those things? What was the benefit to them, both in the US and also outside of the US, for those of us in the rest of the world?
Well, in terms of the US, it's America first, so it's very much a strategy which is looking to protect its own interests. So by definition, you can expect most of the benefits then to come in the US. Of course, that matters to us in the UK, as we'll no doubt be discussing later. The FTSE is pretty much an outward-looking index, the FTSE 100, anything up to 60 to 70% of earnings that are in US dollars. So there is an impact in the UK as well. In terms of infrastructure, if you can get from A to B in a more efficient way, that's a big tick in terms of efficiency. In the meantime, there's people who've got to build that, and notwithstanding the full employment thing we were just talking about, that's more jobs. In terms of corporate tax and that repatriation of money from overseas back to the States, it is currently thought that what's going to happen there is that either companies will go on spending sprees, in other words, that will be good for merger and acquisition activity, or they'll pay down debt, which will make the company more efficient, or they will buy back their own shares, which, all things being equal, should mean less shares in issue, and then the share price goes up. So there are economic reasons. I think the other thing that puts us in a particularly interesting point at the moment is that whilst we are waiting for all this US domestic stuff to actually begin to appear, Trump and his administration have now got the less than small issue of Syria coming up into his sights, because quite apart from what we've actually seen over the last couple of weeks and the action that's been taken, there's now a number of diplomatic talks which need to be had with Russia at the very least. And of course, while all that's going on, that's taken their eye off the ball domestically.
It's not the kind of crisis that you would have wanted at the sort of end of your first 100 days of being president, is it? It looks a lot like the Trump administration might be discovering that this whole being president lark is slightly more complicated than they originally thought. I mean, if that starts to crimp the ability to get some of these things through, Nick, do you think that that's going to then actually start to crimp the Fed's desire to raise interest rates as well?
I think it's very complex. The chief political commentator in the Daily Mail at the weekend was basically saying, I'm absolutely convinced Trump is not going to be here in a year's time. And that was quite a punchy, bold statement. And obviously, we've had some 100 days in, what's actually happened? The market's just gone sideways. I think, there's a question now of this infrastructure spend, the tax cuts, what's actually going to be achieved over the rest of the year?
Well, I think what he has to do is deliver on, I think the promise, inherent in that promise was something that goes back to the post-credit crunch days, and some of this anger is Main Street, not Wall Street. That was the argument, wasn't it? That all of this stuff that was being done was benefiting Wall Street and it wasn't benefiting Main Street. The real man or woman on the street. And a lot of the promises that Trump made to become president, many of the reasons behind his election was some of that anger, and also the rhetoric was, I'm going to help Main Street, not Wall Street. So he needs to get something through to help Main Street, and if he does, then he'll continue to get the backing of the people who voted for him. But without that, then it's going to be a struggle. But the irony is, of course, is that if he does get the stuff through that helps Main Street, then you've got the Federal Reserve, on the other hand, saying, well, we think that's going to be inflationary and we're going to start reining it back in a bit with some interest rate rises.
That's right. And the other thing, of course, is there's a further irony that a lot of his recent or first appointments have been ex-Wall Street people, which would, again, go back to the Wall Street, or is it Main Street argument. And the other thing we've seen, of course, is a massive hike, which has now slightly been undone in bank share prices because, of course, another promise was lighter general regulation, which was seen as being very good for the banks, but again, light on detail at the moment. And
translating that over to this side of the Atlantic, but not to the UK, to Europe. Nick, you've been looking at something in the press, haven't you?
Well, in terms of my little press piece, Tom Stevenson, Fidelity, the headline, why it may be best time to bet on Europe. We haven't seen that for a while. The headlines, triggering Article 50, begins 2 years of really difficult negotiations, which promises to extend the period of volatility. Well, there's clearly no volatility at all at the moment. FTSE 100 is highlighting most at international stock markets, but it's still driven by the investor sentiment at home. British investors' portfolios are more heavily weighted to UK shares. Now, the total value of UK shares represents less than 6% of the worldwide total, but more than 40% of the shares held by British investors are listed in London. So we're still very UK. American shares count for more than half the value of the global stock markets, but only account for a tenth of Britain's portfolios. So clearly we don't like to generally buy shares of overseas equities. Brexit negotiations mean it's now a good time to put your eggs in a few more baskets. And Richard, you always say this, basically, diversify your risk. US stock markets hit by a series of all-time highs, and I forgot this, Snapchat was valued at 60 times its annual sales despite continually making losses, 60 times. Investors have not seen prices like that since the beginning of the dot-com bubble, he said, and Snap rose another 40% after trading began. So they're just extraordinary levels of valuation. Investor interest in American shares has been driven valuations higher across the board. If Trump fails to deliver on the tax cuts, recent shakiness in the market may be the start of a more substantial correction. And at the moment, there's no bears in town. Nobody's bearish. Everyone just thinks this is going onward and upward forever. Treat carefully on Wall Street, says Tom. Other stock markets may look more interesting. He's saying Europe is his top list. The headlines, political uncertainty, hangover from the Eurozone debt crisis and sluggish profits growth. Europe's stock markets are much cheaper than the US. And I thought that was a very good point. Many investors are also attracted to the emerging markets, which have made a dramatic recovery over the last after 4 or 5 years of difficulty. Many options for investors who are unsure about the next 2 years, but no one knows what the single best option will be. And I thought that's a great point. We've got so many clever people out there. Nobody really understands exactly where we're going to be in 2 years' time. And he's to highlight here a well-diversified portfolio providing exposure to all of the world's main markets is probably the best bet.
An interesting point on the US element and the high valuation on the US market as a whole is that, of course, that doesn't mean that it won't continue going up. It could continue going up, but I read a good analogy the other day by a guy called Meb Faber, an American investor, who said it's like being sat in the casino trying to hit 21 and you're on 19. I mean, you could ask for another card and you could, get a 5 or 6 card trick, you could hit 21. Or you could go bust. But if you're sitting there with 9 in your hand, you've got a much greater chance of doing well, haven't you? And that's the similar, it's an analogy on valuation that if you're buying a market when it's already valued very highly, it could continue to go up and you could win. But your chances of winning by buying a market that is valued more lowly, as long as it's not on the downtrend, as long as it starts to pick up a bit, then you've got more cards, you've got more to play with. And that's, very much the sort of the idea behind value investing, isn't it? Is you give yourself much more headroom for gains.
Absolutely right, and that's why this next couple of weeks will be particularly interesting, because obviously we're going to start to get into the first quarter reporting season in earnest, and a lot of this euphoria in the States and to some extent in the UK, you've had a question of a rising tide lifting all boats, which puts the onus back on those companies to come up with the sort of earnings that the market is predicting they will. Now, on a plus or a negative point, that could be the sort of catalyst that we've been looking for in the markets in recent weeks, US president aside, because there are so few other catalysts out there. Even the political risk in Europe, where we got away with not having the populists kind of wave. It didn't go into the Netherlands. Never say never, but it's looking unlikely to go through in France, and of course then we'll move on to Germany. But the very existence of the euro, which has been a major market, a major reason for people avoiding European markets, may actually be taken away. And even US investors at the moment, as Nick's been describing, are starting to consider Europe for the first time in a long time on valuation grounds.
Would you be tempted to look towards Europe?
I'd wait till after April the 23rd. I think that's the date for the French elections.
I think that's probably a good idea, yes.
But I would be very diversified.
Yeah, indeed. That's all we've got time for in this first half of the show. Coming up, we're going to be talking about the best opportunities for the year ahead and the years after that as well. Join us then. Goodbye. Welcome back to the Investing Show. Joining us now, we've got Chris Justham of 7 Investment Management. Chris, welcome to the show.
Thanks for having me.
It's been an interesting start to the year for investors, I think. I'm not sure that there's many who would have actually thought that it would have started quite so well, to be perfectly honest. We've seen the run of record highs for the FTSE 100, and it continued the end of 2016, really. But looking back at that sort of 3 to 6 month period, What's the stuff? What are the companies, the sectors that have done the best for investors over that time?
It's quite a contrast to the previous year, isn't it? I think if we focus on the beginning part of this year, obviously we did have, if you like, the Brexit bounce, which surprised a lot of people after what was an unexpected outcome in many ways. 2016, the year of unexpected outcomes when we look back. But at the beginning of the year, I think there are 2 or 3 things we can focus on. I think a lot of the newspapers have reported specifically on the fact that this is a recovery from the referendum. Ultimately, what we saw after June the 23rd was that the world didn't end. So we're still in a transitional process. We're going to be for the next 24 months at least while we try and work out what's going on in the world, and companies have still got to go and do business. We're seeing consumer confidence is still high across the developed world, so therefore people are still going out and spending money. And when we look at the actual economic fundamentals, which were fairly strong last year, and we've removed, if you like, this uncertainty of these 2 big events, which is Donald Trump and the referendum, we're actually focusing more on the hard data and saying things aren't too bad. You know, whisper it quietly, but things aren't too bad at all. And as the year has started as well, we've had the impact on the FTSE 100 in particular, I'm talking about here, of the fact that China, which is almost bottomed out, if you like, after a really rough period in 2015, 2016, worries about the slowdown impacted the commodity market in particular. And as we know, the FTSE 100 in particular is heavily reliant on the miners and the resource companies. Some of the big wins, if you like, year to date have been the likes of Randgold, Fresnillo, BHP Billiton, and these are companies who are purely doing particularly well share price-wise because commodities have started to recover.
I was looking at the top 10 rises over the last 6 months, and in the FTSE 100, it's a list that includes a number of banks, some house builders, some airlines. I mean, does that look like a bit of a bounce back after the Brexit effect, where everybody looked at those companies and went, oh, get rid of those. Those are the things that are going to do really badly. Then the world didn't end, and they've bounced back.
Those cyclical stocks like banks in particular, you could point the finger at the referendum, I think, and say that the fact that nothing has changed at the moment, and the fact, as I mentioned, the world hasn't ended, that does mean that their share prices have recovered somewhat. You've still got, that is one variable, because if you look at the likes of Barclays the other day, yesterday even with the news there with their CEO, you've got to think of all the other factors that are involved when looking at a share price. But generally speaking, I would say that some of those have recovered after that initial hit where people were worried with that uncertainty. But as I said, until we actually find out what's going on, there is still a lot of uncertainty on the horizon. You've seen some of those recover quite nicely, particularly the ones who enjoy overseas revenues. Like Wolseley is another example of a company that's done particularly well. 2/3 of their revenues come from abroad. So you've got about a 25% rise in their share price over the last quarter. And that's purely as a result of the dollar effect. You've got accountants rubbing their hands together purely because their profit and loss accounts, when they book the earnings back into pounds from dollars, they've done very well indeed.
And as an investor, does that illustrate the importance of not falling for the temptation to make the knee-jerk reaction? So if you were in the position, say, over the course of the Brexit vote, you hadn't taken stock, positioned your portfolio thinking, well, it might go this way, because a lot of people just thought we'd vote to remain. By the time the vote came in, we'd had the week afterwards that was, quite manic. It's too late at that point, isn't it? The worst thing you can be doing is start chucking the baby out with the bathwater, because then you miss the bounce back.
That's right. I think there are 3 things, actually, 3 key points you can concentrate on there when we're talking about investing. One, it's the old eggs in baskets analogy. You don't need to focus purely on the UK. We all have an obsession with what's going on in the FTSE 100. Whenever any of us are asked what's going on in the market, is people referring to what's happening in the FTSE 100. We know that doesn't have a great deal of relevance to the UK economy. So that's the first part. I'd say the second part, and I was saying to Richard earlier, that a lot of people at the moment who are speaking to me are saying, should I get rid of my investments now? Are things looking particularly expensive? Are we going to have a crash? And we've got to remember that if we're going to invest in the first place, and we're not taking a punt, we're not trying to make short-term wins here, and we're going to be leaving it in over 5, 10, 15 years, the last thing you want to be doing is trying to second guess what's going on in the market, because there are far smarter people than I who constantly get it wrong. And these are people who went to cash before the referendum happened, were patting themselves on the back the day of the result, and then after that we've seen an incredible rally since, and those people sat in cash have missed out, and now they're working out when to go back into the market. I think the third thing, just to mention as well, is that if we are going to be taking global exposure, if you are looking at diversification away from just the FTSE 100, you also need to be thinking about the currency impact, because just like when you go on holiday and you have the impact of your currency whenever you go to change it, if you're investing abroad, you've got to be thinking about the currency impact when you book that back into sterling. So those are the 3 things I would say that investors need to look at. It's not just a case of saying what are we going to do from a timing point of view, because it's a lot more complicated.
And that's one of the things, isn't it, when we're talking about asset classes. If you had gone to cash in the UK prior to the referendum, or indeed in the US prior to Trump, quite apart from the fact you'd have missed out on the subsequent rallies, and investment, absolutely, as we know, is for the longer term. There's always that question about where else are you going to put that cash?
Exactly.
I mean, in cash itself, you're losing money with the effects of inflation and so on. Bank and building societies is 0.00. What was that one from a couple of weeks ago?
It was 0.005%.
Yeah, it's just extraordinary. So where else are you going to go? To the extent that there's got to be a certain wall of money within the equity market, even though we all know that there's also a number of professional investors who've been sitting on the sidelines for 12 to 18 months, who've missed 15%, last year, another 15%-ish the year before as well. It's just extraordinary. Where else are you going to park your assets?
Well, that's right, and I think what a lot of people traditionally would have done is said, oh, equities are looking a bit scary, I'm going to go into fixed interest. We know you can't do that in the developed markets at the moment because you're almost, over the short to medium term, looking at a guaranteed loss. And these are things we're going to see huge headlines about going forward, because some of the pension funds, who are still, if you like, long duration gilts, so developed market bonds, whether that be treasuries, whether that be gilts, bunds, are going to be feeling pain at some point over the next year or two. So you make a great point that if you are going to be committing your money over the longer term, the asset allocation, if you like, diversification of asset classes and leaving the money away to work for you, it means it will go down over the short to medium term. It'll be flat at some points, it'll be up. But ultimately, if you've got your plan right and you know that you've got enough cash aside for a rainy day and that the short-term fluctuations aren't going to hurt you and impact your plan, then don't worry about it too much.
When you're talking to investors about that problem of what do you do with the safe bit of your portfolio at the moment, because bonds, they are expensive. They do look risky. I mean, we've had countless warnings about them that have not come to pass that greatly, but you do think at some point that may happen. How do you deal with that, for investors? In terms of that the safe chunk of money, the bit that isn't the equities bit?
It's a great question, and diversification, I mean, it's a horrible word in many ways because it's used so badly. So just owning 15 different stocks, modern portfolio theory, if you like, that Markowitz, the old school way of looking at things, which is, it doesn't matter what you've got diversification if you've got a load of different stocks. From a non-systematic point of view, i.e. you've got diversification, don't worry too much. Ultimately, from our point of view, that you need to be looking at what correlates with one another. So, for example, the old adage that if the US sneezes, the UK catches a cold. Great example, and we'll come on to, I'm sure, Donald Trump a little bit later, and we're talking about what's going to be happening going forward and what our forecasts are. But ultimately, if things do move in a similar fashion, where if the market goes up or down, you haven't got diversification because they're acting in the same way. So from our point of view at the moment, we're looking a lot more on alternatives. And really, alternatives, I mean, it sounds like quite an opaque statement, but that's everything from commodities like gold, so that's quite a nice inflation hedge, as well as the fact that if you do have a risk-off event, that's one that everyone tends to flood to. We're looking at inflation certificates, we're looking at protecting currency on the downside, and we're looking also at certain market-neutral strategies which take advantage of certain constraints, if you like, within certain areas of the market that aren't correlated with what's going on with equities or bonds or another. Because you're absolutely right, you can no longer just go from equities to bonds. You need to have something else which is doing something slightly different.
And looking forwards, obviously, can we just expect the things that have done well to continue doing well? And that's always a very dangerous way of looking at anything, isn't it? And in fact, I saw a piece of research today that looked at the best performing asset classes of the last 20 years, and no asset class had performed best 2 years in a row. So that illustrates why you shouldn't just look in the rearview mirror at what did well last year and buy it. But looking to the future, what can we expect to do well? The same thing or different things?
Well, I think that the point you made is a great one, which is if you look at the asset classes and you split them out into how they performed on a discrete annual basis, so from January to December, if you look back over the last 10 to 15 years, and then you say to people from a behavioural point of view, what are you going to pick next year? They'll always pick the one that's done well in the year that they're looking at. And it's not the way, unfortunately, that it works. It'd be a lot easier for all of us if it was. So from a crystal ball gazing point of view, I'm always reluctant, if you like, to make that call and say that specific area. For us, it's a case of weighing up where the economic fundamentals look particularly good, so from an asset allocation point of view, versus where there might be other political risks. So a great example of that at the moment is we really liked the US at the back part of last year, particularly Russell 2000, so some of the smaller companies that were more exposed to Donald Trump's America First domestic pro policies. But At the same time, as we've gone into this year, and he's shown that from a political point of view, he's been a little bit distracted with the repealing of the Obamacare and the fact that he's now got this whole fiscal situation he's got to address. Is this enthusiastic novice, ultimately, that's now in charge, going to be able to push through these things that are going to have the positive impact, I suppose, that many of the equity valuations are waiting to see? So those high valuations are waiting to see whether or not that was justified. So we've always got to weigh up going forward the political situation, if you like, at the moment, particularly in Europe and in the US, versus what's going on with the economic fundamentals. We think that Europe, at the moment, despite the political situation, we think a lot of that is priced in. So we do like Europe, not to the point where we have a significant overweight, but we haven't taken all the risk off the table there. Japan's an interesting one as well. Some of the valuations there are a little bit more attractive. Whilst the yen has strengthened in recent weeks, we think that there is a case that might weaken in due course, with a view that the exporters that Japan relies on should do particularly well, as well as the fact that Mr. Abe as well is getting on with, albeit with a slight tainting of corruption that we've seen in the background that he's having to deal with some of the policies in his Abenomics. So there are some areas still that you can look at and you think there is value there, albeit in the developed markets, I think people are a little bit cautious, just waiting to see what happens with Mr. Trump, as well as with Brexit as well, with the FTSE 250 and some of those domestic companies in the UK.
Richard, do you think there's a bit more of an air of caution going on? I know going back over a few weeks, a couple of months, you were slightly concerned that too much caution was being thrown to the wind.
Yeah, and also that I think we said on the last show that I'd be pretty relaxed at the moment, and it's not something you normally want to hear a broker saying, if we had a bit of a correction, just to let some air out of the tyres, just to get some new entry points and just to rebalance expectations, because we're not at lofty valuations, but they're starting to get a little bit rich, and certainly over the last 3 or 4 weeks there hasn't really been any sort of positive catalyst coming along that might change that expectation. So we're kind of treading water at the moment. I think one of the things that could actually help, ironically, is to have something of a pullback.
Mm-hmm. Would you agree with that, Chris?
I think the inflation piece is going to be the interesting one as well going forward, because if that continues to pick up and we see that the consumers in the UK who have driven, if you like, this recovery, I mentioned the consumer confidence point earlier, both in Europe and in the UK, that continues to tick through with the fact that the base effect of oil has now fallen out of the numbers, as well as the huge devaluation in sterling, we might then see an impact on some of the domestic companies who are, if you like, reliant on the UK consumers. Indeed, we saw retailers struggling, if you like, in terms of sales the third month in a row. So those are the types of things from a UK point of view I'll be looking at, as well as those domestic companies. I think you would have to be quite brave at the moment to make a specific call about a certain sector when we've got so much uncertainty on the table. It's really difficult to say that any of the economic data will win out when you've got so much political uncertainty on the horizon.
Cautiously optimistic?
I think with all of these things that it's a case of seeing what happens on a day-by-day basis, particularly what we've seen over the last 8 to 9 months. At the risk of giving you a political answer there, it's purely as a case of unexpected outcomes, as I mentioned in 2016, and then going forward, I think don't be hasty, don't suddenly think, we've got to throw the baby out with the bathwater. It's just a case of making sure your assets are allocated across the board and you're constantly reviewing it.
Chris, thanks very much. That's all we've got time for. Thank you.
Thanks.
Richard, thank you. Thank you for watching. Goodbye.